Our next presentation, Commodity Price Risk Management for Processors, is presented by Adam Stout, who is a risk management consultant for StoneX Financial Incorporated, where he specializes in offering risk management services to the livestock and meat industry. Adam joined the company back in 2005 and today helps his customer base of livestock producers, meat processors, and end users such as retail outlets and restaurant chains by providing consulting and advisory services, as well as the execution of hedge strategies using exchange-traded futures and options and over-the-counter instruments. He received both his Bachelor of Business Administration and Mathematics degrees from William Jewell College in Liberty, Missouri. Adam, you can begin sharing your screen now.
All right. Well, thank you, Joe. As Joe mentioned, my name is Adam Stout, and I work for StoneX. StoneX is a financial services firm. I work as a member of our commodity risk management division, specializing in the agricultural commodities. So we help to implement and manage the commodity risk management programs for meat and livestock, as well as the grain and oilseed markets. Joe invited me to speak to you guys today to talk about commodity price risk management. I will admit that in the 30-minute time slot, we won't be able to get into all of the details about a commodities hedging program, but I'm hopeful that by the end of the presentation and then a short question and answer session that everyone at least has an introduction to commodities hedging, as well as some of the newer financial instruments that are available to help mitigate the price risk associated with the beef and pork products specifically. So, as I mentioned, StoneX is a financial services firm and a heavily regulated one at that. And so prior to any speaking engagements, including Zoom calls, our compliance department does require that we show our disclaimer. Now that we got that out of the way, let's go ahead and get started. When we say commodity price risk management, what we're talking about are the tools and the strategies that can be utilized to help mitigate the price risk to a certain commodity. So in this industry, I mean, if you look at livestock and meat prices, we have seen increased levels of volatility over the past 10 years. Now, 2020 would have been an extreme example with the shutdown of the food service industry and then the shutdown of the processing plants shortly thereafter. But even in the years prior, we went through things like an ASF outbreak in China or a PED outbreak here in the U.S., a plant fire at one of the key beef processing plants, or a drought in the southwestern plains that helped push the U.S. cattle herd to multi-decade lows. And so, as you can see in the charts on this page, the chart on the upper left being the USDA's choice beef cutout versus CME live cattle futures, or the chart on the bottom right, the USDA pork cutout versus CME lean hog futures, we've seen some extreme price moves over the past 10 years. And what we want to talk about today are the tools and the strategies that we can utilize to help mitigate some of these risks and flatten these extreme price moves. So StoneX is a financial services firm, but when we talk about commodity risk management, we also want to talk and look at some of the physical market strategies that might be available. Physical market price risk management strategies are going to include things like fixed price contracts or buy and store or buy and freeze programs. We'd even have some clients that have gone to tolling arrangements. Any of these strategies allow buyers or sellers of these commodities to reduce their risk exposure and ultimately better manage their budgets, their margins, and bottom line profitability. Now, one issue that exists is that these strategies aren't always available. one thing that we've seen, and especially over these 10 years where we've seen increased volatility in the industry, is a reluctance on the part of some suppliers to offer fixed price contracts. In addition, physical market strategies, something like a buy and store or a buy and freeze program, can be capital intensive. That's a big capital outlay to buy all those goods up front. And so in addition to these strategies, and we want to make sure that we have these as part of our program, we also want to look at some of the financial market strategies that could be available. So when we talk about a financial market strategy, the important thing to note is that any strategy consists of two parts. There's the physical market, and then there's going to be the financial market. And to measure the effectiveness or the net hedge result of any financial market hedge strategy, we need to look at the net of both of those two positions. Two important terms when we're talking about commodity risk management are equal and offsetting. Hedging is always going to require the use of equal and offsetting positions between the physical and the financial markets. And so I think a lot of the people that are participating in today's calls are going to be a consumer of a commodity, right? If we are a consumer of the physical commodity, we're effectively short that commodity. We have risk in an up market, a risk of higher prices. And so if that's the case, in the financial markets, we need to be a buyer of that financial instrument. We need to go long the financial market, something that's going to gain value in an up market so that those financial hedges are gaining value to offset the higher spend in the physical marketplace. Now, the inverse would be true for the producer of a commodity. If we're a producer of a commodity, our risk is in a down market, right? We are long the commodity at risk of that market going lower. And as a result, we need to be a seller of the financial products, or we need to short the financial market so that they gain value in a down market. When looking at the financial markets and the tools that are available, we first want to look at some of the exchange-traded alternatives. So the exchange-traded platform, and when I say exchange, I'm referring to a futures exchange or a centralized marketplace where commodity futures and options are bought and sold. And there's going to be two alternatives. There's exchange-traded futures and there's exchange-traded options. A futures contract is a financial contract for a specific commodity for a specific time into the future. All right, these are very standardized contracts, quantity, type and grade, delivery location, delivery time, all of those are set and established by the exchange. The only thing that's negotiated in a futures contract is the price. Now, if we were to buy or sell a futures contract, we will either have to offset that position or be obligated to perform, as in take or make delivery of that commodity at that time in the future. Now, though, the majority of all futures contracts that are traded are offset. Less than 1% of traded futures contracts actually make it to the delivery process, but it exists to help ensure the integrity of the futures contract. The other tool, and we're not going to spend a lot of time talking about options, just due to time limitations. The options would be the other tool. There's basically two types of options. There's call options and there's put options. A call option, the buyer of a call option is buying the right to buy an underlying commodity futures contract at a pre-established price for a negotiated premium. The buyer of a put option is buying the right to sell the underlying commodity futures contract for a pre-established price for a negotiated premium. So the buyers of options are buying the right and they're paying the premium. the seller of the option gets to collect the premium, but they're going to be obligated to perform in the future if the buyer so chooses. A couple of examples, a futures example. CME live cattle futures are a 40,000 pound contract, right? So one contract of live cattle futures is 40,000 pounds of cattle. Below, you can see some of the specs that are set by the USDA, right? The cattle need to be USDA yield grade 3, 70% choice, 30% select. No individual animal can weigh less than 1,050 pounds or more than 1,500 pounds. And they're going to be delivered to approved yards in the states that are listed. Those delivery periods take place relative to the contracts that are listed. And so in live cattle, they list contracts in February, April, June, August, October, and December. And below, you can see some pricing indications for those contracts. The presentation was actually put together a couple of weeks ago, so these are going to be a little bit dated. You can see different price levels for each one of those different delivery periods. Another futures example, and this is, I actually included this one. This is one of the CME's latest offerings. They've recently released and started trading futures on the pork cutout in November. Similar to cattle, it's a 40,000 pound contract. It's 40,000 pounds of pork carcasses per contract. You can see some of the specs of those carcasses below. Now, one big difference in the CME's pork cutout contracts versus the live cattle contracts is they're actually a financially settled contract. So instead of having a delivery component, pork cutout futures are going to settle versus an index price that the CME publishes. Contracts are going to be listed for February, April, May, June, July, August, and then October, December. And again, you can see some of the prices for those contracts listed below. As we go past the exchange traded platform, though, what we want to look at are some of the other alternatives, right? These are some of the newer contract offerings that I mentioned earlier, and these are available via the over-the-counter platform. So what is an over-the-counter product or a swap, as they're commonly referred to? An OTC product is a financial contract that's traded bilaterally off of an exchange, right? So instead of going to a central marketplace, we're lining up buyers and sellers and executing these contracts off the exchange. The prices for a swap are going to reference a specific futures contract or some market respected index price. So for instance, we could execute a swap versus the CME lean hog futures contract. Okay, the swap's going to look, feel, act, everything like CME lean hog futures, but it's going to be executed bilaterally off exchange. And there's a couple different reasons that people might want to do this. As we described earlier, a lot of these futures contracts they're very standardized. Not a lot of customization can take place. And we can get away from a little bit of that in the over-the-counter platform. So if a party would prefer to trade CME lean hog futures in 20,000 pound increments instead of 40,000 pound increments like they're required to on the exchange, you could do that via OTC. Or if you wanted a delivery period or settlement period in March versus February or April, like is available on the exchange. So there's just a little bit more customization that's available. A couple of other examples of swaps, and these would reference market respected index prices. Both would be applicable to this industry as well, would be a swap versus the Department of Energy's on-highway diesel fuel price. So if you have any risk exposure to diesel fuel prices, whether that's through a direct fuel expense or a fuel surcharge schedule, you could execute a swap versus the Department of Energy's on-highway diesel fuel price to mitigate that risk. Another example would be interest rates. If you wanted to lock in interest rates at the depressed levels we're seeing currently, you could do that via a swap on LIBOR's interest rates. So all of these over-the-counter products, they are financially settled. There is no delivery component to OTCs. And all of the settlement dates and volumes are specified up front when the contract originates. So for the protein industry, and where this comes into play, right, the industry's long been looking for an alternative outlet to manage its risks, right, the risks of beef and pork products. So as we described earlier, some of the physical market strategies are not always available. They can also be capital intensive. If you turn to the exchange, there are some products listed, but a lot of those contracts require some form of ratio hedging. So if you were to hedge a specific beef cut against live cattle future, there's some ratio component that needs to be utilized because you're hedging a specific beef cut against an on-hoof animal. And so just over time, that's proven very difficult. And even with the CME's new pork cutout contract, there's going to be some degree of ratio hedging that's still required. So ultimately, what we were looking or searching for was a more highly correlated financial instrument. And that's where we've come to these beef and pork product swaps. So at StoneX, we've been executing swaps against beef and pork products for about 15 years. We've seen an increased trade volume, increased usage over the last 7 or 8. I think a lot of that has to do with the volatility that we discussed earlier, right? These products have become more volatile over the past 10 years. And so that's pushing more people to look for some hedging alternatives. In addition, we've listed additional products to better meet client needs. And so, as I mentioned, for any OTC, we have to reference a market-respected index price. In the case of the beef and pork product swaps, we reference USDA reports. In many instances, buyers are formula priced off of these reports, and so very good, very strong correlations available in a lot of these products. The swaps are going to be financially settled. There is no physical delivery component, and the settlements take place weekly, with the settlement weeks and the volume per week all established up front when the contract originates. As I described, we've added product listings so that customers can find better correlated solutions. On the beef side, a lot of our interest from a hedging standpoint has come in the trimmings markets. So we've listed swaps against all of the key trimmings products, the USDA fresh beef 90s, beef 85s, beef 65s, and beef 50s. In addition, we have a couple of preset blends, an 80% point of lean blend of beef 85s and beef 50s, and then a 75% point of lean blend of beef 90s and beef 50s. The preset blends were the products that we'd listed initially. Those matched client-specific needs. We've since listed all of the products, all of the trimmings products, and now clients are able to put those together to match their specific point of leans. Again, a better correlated solution as they look to mitigate their risks. On the pork product side, a little bit more diversity in the product mix. There's a cutout swap. There's swaps against both the pork 72 and pork 42 trim. There is a preset blend of pork 42s and pork 72s. We also have products against the ham, the pork butt, a loin, belly, the belly primal or bacon, as well as back ribs. And all of these products are used by an array of players, right? There's the processors that are participating in these markets, which I'd count the main packers among them. We also deal with grinders and further processors, restaurant groups or food buying co-ops, as well as livestock producers and speculative market makers. What I thought we would do, going through a little bit, now that we've had an introduction to what the tools are, I thought it'd be helpful to put a little bit of a real world scenario together to show how the tools work, what the decision making process looks like. So what I chose to do was go back to the fourth quarter of this year. Saw a lot of interest in some of the ham swaps in particular. So pulling one of those out and just walking through what that looked like. So if we went back to November, a ham processing company would have come to us, and I'll just refer to them as HPC. They were coming to us looking to protect their margin on a fixed forward sale of ham for the upcoming Easter season, right? They're going to make those hams from January to March. And so they're looking at some way to mitigate that risk on those purchases from January through March. And so the alternatives that they have, right? They could do nothing and hope that the ham prices that they're buying are cheaper than the prices used to establish the fixed forward sale. In the industry, a lot of times, we think about this as forecasting, right? We use our forecast to establish what our sales price would be. And forecast at times can be accurate, but ultimately at the end of the day, what we are doing is hoping that whatever we buy is cheaper than the price that we're selling it at. So that's option one. We could forward contract the hams from the suppliers if possible. Or we could look to the financial markets and utilize a swap against the 23 to 27 pound ham swap to protect that risk. Now, if we went back to mid-November, the 23 to 27 pound ham was trading at around 75 cents. We could buy the forward swap for January through March at about 65 cents. And so for this scenario, I think what HPC needs to do is say, okay, we can do nothing and hope. If we can get a forward contract from the packer, we could do that. In this example, let's just say that forward offer is at 68, right? So we want to compare what we can do in the physical market against what the financial market looks like and just choose the best alternative. So for this example, we'll go out, we're going to buy the 23 to 27 pound ham swap to mitigate that risk in ham prices from January through March. We'll buy that swap at 65 cents. If you went back and looked historically, it's going to look something like this, and we've talked about the increased volatility in the ham market. I think the ham is a great example of that. We've seen pretty much the highs and lows of ham in the last 18 months. And so we see the swings, and then at the very far right-hand side of the chart, you can see that flat blue line. That's what we're attempting to do, right? We're trying to take out the highs and lows in that market and just set a fixed price to protect our inputs. That's going to look something like this. So if you follow me from left to right, ham processing company back in mid-November, they're going to go out and commit to buying this swap at 65 cents. So they're buying the 23, 27 pound ham swap at 65 for settlement each week through the month of January, through the month of February, through the month of March, okay? As we enter into the settlement process, okay, as we enter into January through March, HPC is going to continue to buy its hams from its normal suppliers at prevailing spot market prices each week. At the same time, each week, a weekly increment of their ham swap is going to settle versus the USDA's weekly weighted average price, as it reports in its report LMPK 610. Any gains or losses from the ham swap are going to be applied to the spot market price that HPC pays for hams, with gains offsetting a higher price paid for ham or losses offsetting a lower price paid for hams. And so if we walked into that first week, right, the week ending January 8th, starting on the left-hand side, HPC in the physical market was able to buy hams at 59.09 cents. Okay, that's what they paid their supplier for ham. HPC was also long the ham swap at 65 cents. That swap, week one, settled at 59.09. Okay, so they have a 5.91 cent loss on that first week's ham swaps. That loss gets added back into the 59.09 that HPC paid. Their net ham price that first week is 65. Okay, we continue that into the second week, right? We've seen ham prices increase. HPC's watched their price go from an average of 59.09 the first week to 67.10 week two. Okay, that week though, they're also long that ham swap at 65 cents. It settles against that price of 67.10. The 2.1 cent gain is then applied to the 67.10 that they paid the packer or the supplier. That nets out to HPC back to that price of 65 cents. Right? And this process is going to continue each week until we get to the week ending April 2nd. The thing that I want to point out though is that regardless of which direction the market goes, right? If the market's going higher or the market's going lower, HPC's net effective price is always going to be 65 cents. Okay, they were able to take out the swings in the physical market, set a static price, which they would then therefore be using to help set against that fixed forward sale and lock in a margin. And so that's, as we talk about the benefits of these swaps, or better yet, the benefits of commodity hedging and commodity risk management in its entirety, is they provide us another outlet, right? It's another outlet for hedging. These financial products can be less capital intensive than a freeze and store program. The swaps will correlate at a much higher percentage to beef and pork prices than any of the exchange traded futures or options contracts. And in many instances, as we talked about earlier, they're going to correlate at 100% because a lot of the suppliers are charging for these products on a formula versus the same USDA indices we're using. And ultimately, what all of it does is it allows buyers and sellers of these commodities to reduce risk exposure, better manage budgets, margins, and ultimately achieve better bottom line profitability. And that wraps up my piece for today. We'll be available here for if we've got some time for a little bit of a Q&A session, but turn it back over to Joe.
All right, thank you, Adam. We will give it a few minutes and see if we have some questions come in. We don't have any questions right now. Maybe we'll have a couple.
I think everyone's just trying to digest all the data they just saw.
Try not to get too much into the weeds on some of those examples, but I do think just actual application is helpful. So.
Well, Adam, thank you again so much. We don't have any questions in the queue, so I think in the interest of time, we're probably going to move on. I know that you're doing business with some current SMA members, and heard great things about your company. So we appreciate you sharing that information. I know it was informative, and I learned a lot.
Absolutely appreciate it, and hopefully we'll be able to do it again sometime in the future. Maybe back to in person. So
Absolutely.